Please, Judy.
Mr. Kelly?
Here.
Ms. Cavanis?
Here.
Mr. Haschak?
Here.
Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Cubison?
Here.
Mr. Land?
Here.
Thank you.
Trustee Kelly, please lead us in the Pledge of Allegiance.
With me, please. I pledge allegiance to
The flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
The Mendocino County Board of Retirement meeting for April 15th, 2026 is called to order at 8:37. Do we have any public expression or comments for items not on the agenda? Anybody?
I just
Not-
missed it. I got blown off. How do I get in? Where is it?
We can hear and see you.
You're on.
I can't see you. I was adjusting my volume, so what do I do? Do I have to back out and join again?
You
Okay,
should
we're-
be able to turn your camera, well, I don't know why you can't see
His
us.
camera's on. Did you minimize your screen? Can you maximize your screen?
I think he moved something and now it's there, but he needs to move something on the screen.
I can hear you. Go ahead. I don't want to hold the meeting up.
Okay, so seeing no public expression for items not on the agenda, unless there is public expression for items not on the agenda, there is none. We're going to move on to item number 1, proclamation honoring Charles Kelly for his service to the Mendocino County Employees Retirement Association Board of Retirement. And I will read the proclamation. Proclamation of the Mendocino County Board of Retirement honoring Charles Kelly for his service to the Mendocino County Employees Retirement Association and the Board of Retirement. Whereas Charles Kelly has served with distinction as a Board of Retirement trustee since August 16th, 2023, following his appointment by the Mendocino County Board of Supervisors, serving as Board Secretary from March 19th, 2025 through December 17th of 2025. Whereas Charles' extensive knowledge of investment and pleasant demeanor has been a valued addition to the board, and whereas Charles' support of and thoughtful attention to important investment matters assisted the board in making important decisions regarding core and core plus real estate, small and mid-cap and international equity structure review and manager selection, and whereas Charles' contribution included participation in the board strategic planning, Kings Court ADA project completion, and historical correction project completion. And whereas Charles has demonstrated his commitment and dedication to serving as trustee, he has always exhibited the highest principles of collegiality and respect for Mixera, its board and staff and members. Now, therefore, be it resolved that the Mendocino County Board of Retirement applauds Charles Kelly for his service and expresses its sincerest appreciation. Charles is wished continued happiness in his retirement. Is there any discussion? Thank you very much for your service.
I would say it's been a pleasure. It has been a pleasure seeing the smiling faces around the room. I've learned over the couple of years that the Mendocino County Employees Retirement Association has a very professional staff that is doing a spectacular job keeping things together. Makes being on a board pretty simple. So I want to applaud myself, Judy, Robert, Doris, for all you've done for the association, and indeed making my job as a trustee easy.
Thank you, Charlie. We'll miss you.
Yes.
And I wish I could continue to serve, but in my declining years, I'm just trying to simplify my life. I actually bailed on 2 other boards that over the last couple of years that were very important to me. But so this is just one more. Trying to settle down.
You do.
Okay, anybody else comments? Is there any public comment?
There is none.
Seeing none? Okay, that will move us on to item number 2, which is closed session. And I believe at this point, Jeff, I need to call for public comment again before we move into closed session. And do I announce the item A, or is it conference with legal counsel, anticipated litigation pursuant to Government Code Section 54956.9B2? One case, Philip Pintane. And I'm not seeing any, is there any public
No, no
comment?
public comment.
Okay, that will move us into closed session. And I believe we need to do that.
See if I can get.
Okay, this brings up item number 3, consideration and action on appeal of correction notice by retired member Philip Pintane. Doris Rinchler, Executive Director.
Thank you, Chair Land. This matter is being brought back to the board. Additional briefs from Mr. Pintane and MSERA's attorneys are provided in your materials, and I will turn it over to Jeff, or actually you have some introductory language, Chair?
Right, and so we'll start with this. Mr. Pintane is represented by James D. Martini, is that correct?
That's correct.
Okay. Mr. Westerfield, you are representing MSERA, is that correct?
That is correct.
Okay, the trustees have received briefing documents from each side that lay out your respective positions. As provided in MSERA's administrative hearing policy, each side will have 10 minutes for oral argument. The trustee will then have an opportunity to ask questions, if any. After oral argument, the board will meet in closed session to deliberate and will return to open session to announce its decision. Are there any questions about the process? Okay.
Do we have to do a public comment?
I don't have a note for that, but do we need that? Is public comment required at this point? Okay. Mr. DiMartini, you go first, starting at 8:55.
Thank you, sir. You know, this dispute is really a question of fairness. And there's 2 issues I wanted to address that have to do with fairness. Sarah says, look, we made a mistake. And as Mr. Westerfield has testified, the staff made numerous mistakes, one mistake after another. And the problem with justifying your action on a, quote, mistake, a mistake that no one has actually said what constituted the mistake. The problem is no one can say who made that call, who made the mistake. In terms of fairness, I, on behalf of my client, ought to be able to talk to that person to confirm that, yes, this is what they did, and yes, this is why they did it, and then determine whether it was in fact a mistake. In the absence of providing the identity of that person, it's just not fair to say, well, it's just a mistake. We're assuming it was a mistake. And I can't see you taking someone's vested rights for which she worked 27 years to obtain based on something you assume. I mean, if there was a mistake, bring that person out, have them say, yes, I made a mistake, or this is why I did what I was doing. And then have someone say, well, that was a mistake. But you can see, and we pointed out in both our briefs, notably the retirement ledger from December 31st, 1993, where Mr. Pintain's status was confirmed, was verified as safety tier 1. So not only was allegedly a mistake made putting him in tier 1, and someone in 1993 made another mistake, apparently looked at the record and confirmed that he was safety tier 1. Again, until I can talk to that person, and if it goes beyond this stage, I mean, clearly I'll have a right to discovery, and we'll find that person and ask them that question. It's really your burden, or it's Sarah's burden. I'm sorry. They're the ones that are obliged to say a mistake was made. This is the person who made the mistake, and this is the effect it had. The second fairness argument is the estoppel. Phil stayed on the job in complete reliance on what he was told by Sarah representatives was his status. And this is what he was going to earn in retirement. Based on that, and as he will testify under oath eventually, if this is unsuccessful today, is I relied completely on what I was told. I did it. I planned my life around it. I retired based on a certain set of circumstances that I was assured was the case. And now go back 17 years later and say, whoa, wait a minute, somebody made a mistake a long time ago. And it doesn't matter that you relied on that. No, both sides have cited to the Medina case, and I believe that it supports our position that if every element is met, and I'm not going to repeat my brief because it's there in front of you, all 4 elements have been met to show that Mr. Pintain has every right to rely on an estoppel defense. The final unfairness argument is when we talked about a gift of public funds. I mean, this board has made gifts of public funds in the past to correct mistakes. The buy-in of service years for retirement purposes is just an example. That covered a multitude of situations involving many employees, and it was resolved by saying, fine, we're going to do it this way. And it because of the nature of their situation and the nature of the issues, it really wasn't a gift of public funds. It was what was represented to these people and what they all relied on. So all 3 elements that have been raised in your attorney's briefs, mistake, estoppel, and gift, none of them are supported by the evidence. And until and unless someone shows up and looks me in the eye and says under oath, yeah, I did that. And someone else under oath looks me in the eye and says, yeah, that was a mistake because I think Mr. Pintain has to prevail in this matter, and eventually he will. I'll submit it.
Mr. DiMartini? Seeing no questions, Mr. Westerfield, please proceed at 9 o'clock.
Good morning, board members. It's good to see you again. So the last time that the board heard this matter was about 6 months ago in October of 2025. It determined that Mr. Pintain was a Tier 2 member during the entirety of his employment, and that his retirement allowance must thus be calculated based on the 3-year final average salary period that's applicable to Tier 2 members. The board should reaffirm that conclusion again today because none of the relevant facts or the law here have changed. So this matter is before you again because of an error in MSERA's previous representations to the board or previous presentations to the board. We represented that Mr. Pintain had paid Tier 2 rates during the entirety of his employment. Upon the direction received by the board to investigate the contribution rate history, it was determined that this was not correct. And I just want to apologize personally to the board for making that representation. So to just clarify numerically what the effects of the contributions and the overpayments were, and this is in our brief, but I just want to repeat it here. Mr. Pintain began paying Tier 1 rates in the early 90s through his retirement in 2008. As a result of paying Tier 1 rates, he overpaid about $2,500 in contributions. Between his retirement and the date of correction, however, he received about $209,000 in overpaid benefits. So we recognize that there was some overpayment in contributions here, although, of course, the overpayment in benefits far outstrips that by a couple of orders of magnitude. So turning to the merits of this matter, there's just no evidence suggesting that Mr. Pintain's classification was a result of anything other than a mistake or paperwork error. Just as a quick point of factual correction, again, this is in our brief, but I heard Mr. DeMartini make a note to this effect. This was not a MSERA paperwork error. MSERA doesn't directly enroll people in tiers or adjust people in tiers. That's something that would be done through the county payroll system. So this isn't a case where, MSERA made a giant mistake, made a big representation to Mr. Pintain to the effect of being enrolled in Tier 1. Contemporaneously with his alleged reclassification, this was a mistake made by somebody at the county. Mr. Pintain was enrolled, and how do we know it was a mistake? He was enrolled well after Tier 2 took effect. There's just no basis on the record, and MSERA hasn't discovered one since filing its brief. Certainly if there was a basis for a tier classification, we want to know about it, that would support an intentional tier change. So the argument that I've heard from Mr. Pintain's attorney that, there's essentially no who, what, when, where, how evidence as to how this mistake was made, that's just not legally or logically sound. The law is clear that an absence of evidence on a particular fact is not evidence of a particular fact. That is, just because there isn't any factual record about the details of how the mistake was made, that can't support an inference that no mistake was made and that there was an intentional reclassification here. Another note as to the burden of proof, it does not rest with MSERA in this proceeding. This is clear from Section 3F of the Administrative Hearing Policies. And again, there's just been no affirmative evidence offered at all that this was an intentional reclassification by the county. With the understanding that Mr. Pintain's classification as a Tier 1 employee was the result of a mistake, the law is clear about what MSERA has to do here. So under California law, retirement systems can correct mistaken classifications and correct calculation mistakes. That's true even if they affect the allowance amount of retired members. Now, Mr. DeMartini stated that Mr. Pintain has a vested right to this retirement allowance amount. That's just not true because it was based on a mistake. You can see this on the Blazer case. It's cited at page 7 of our brief. It's there in black and white Court of Appeal talking. Knowingly paying a benefit based on a mistake is an unconstitutional gift of funds. In other words, because the law is clear that Mr. Pintain doesn't have a right to a mistakenly calculated benefit, the law is also clear that MSERA cannot, as a matter of constitutional law, continue to pay that benefit. That's from another Blazer case. There were two with that title on page 8. The City of Oakland case that's cited in Mr. Pintain's brief applies in a different context here. It means essentially that it's not an unconstitutional gift of public funds for the board not to recoup any of the mistakenly paid amounts to Mr. Pintain. So that is the $209,000 of overpayments that I discussed at the beginning. It's not a gift of public funds not to claw those back from Mr. Pintain, and MSERA is not seeking to do that here. So the City of Oakland case just isn't really applicable to this dispute. Because Mr. Pintain has no right to a benefit based on mistake, and because the Constitution prohibits allowance payments that are based on mistake, there's no fiduciary duty to continue paying a benefit at an incorrectly calculated amount. Equitable estoppel, moreover, just can't apply here because equitable estoppel, it's an equitable doctrine. It cannot supersede or override statutory or constitutional law. It's just noted there's a clear constitutional prohibition on continuing to pay a mistakenly calculated benefit in this case. As to the particular elements of equitable estoppel, I would certainly dispute that those elements are met here. The first of these elements is that MSERA knew of the facts. I don't think MSERA was aware that Mr. Pintain had been erroneously calculated as a Tier 1 member until it discovered this issue in 2025. As to element 2, I don't think MSERA intended Mr. Pintain to rely on any representation it made about its, about his tier category. And finally, MSERA has, just a further point on equitable estoppel. Again, this is in our brief. I just want to reemphasize it here. It is extraordinarily difficult for that doctrine to be applied against public entities. That's in part because of the constitutional note that I noted earlier. That is, that it's impossible for equitable estoppel to override statutory and constitutional law because public entities, pretty much all their rules are governed by statutes and the Constitution. It's just very difficult as a matter of common law for equitable estoppel to, make a public agency do something that some other source of law, in this case, the Constitution, says that it can't do. And finally, MSERA has favored status under federal tax law. In order to preserve that status, something that's obviously very important to MSERA, it just cannot knowingly continue to pay benefits at incorrect amounts. And I don't have anything further to note here, but I'm happy to address any questions that the board might have.
Okay, my next instruction here is to say that we will be moving into closed session to consider this item. If Scott says we're ready and Judy says we're ready, we're back in open session.
We are ready.
Okay, so we are ready to, I'm ready to ask if trustees are, if anybody would like to make a motion.
I'll make the motion. I move that the board deny the request on the appeal.
Second?
Okay, we have a motion and a second. Do we need to ask for public comment at this point?
No.
No? Okay.
No, just do roll call vote.
Okay, Judy, roll call vote, please.
Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Ms. Cubison?
Aye.
Mr. Land?
Aye.
Okay, unanimous. Thank you.
Okay, MSERA will notify the parties in writing of the board's decision within 10 days.
Very much.
Yeah.
Thank you for your courtesy.
Thank you.
Okay, get my bearings here. That's going to bring us to item number 4, consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does anybody wish to pull or discuss any items on the consent agenda? Don't see anybody making such a request, so we are going to approve the consent agenda by unanimous consent. Item number 5, investment matters. And our first presentation on investment matters is PGIM small cap value presentation. And we have a Chris and a Patrick. Chris Zani and Patrick McMenamin.
That's pretty good.
McMenamin.
Nobody really ever gets it on the first try, so that's very close. Thank you for having us. So great, I see you have the presentation up here. Would you mind going to slide 4 to start?
Sorry, I'm trying to
Keep full
do a
screen.
few things. Yeah, I just want to switch this up here. Let's see if we can. No.
Just
Okay.
minimize it.
Yeah. Let's minimize this and do this and let's page down 4. Here you go.
Great, perfect. Well, good morning, everybody. And well, first and foremost, we want to thank you for your business. And you've been with us, PGIM Quantitative Solutions, and the small cap value strategy for well over a decade. So, and and hopefully it's been a mutually beneficial relationship. We've enjoyed working with the Mendocino County group here over these years, and we're here to present you with, I think, what are just pretty compelling numbers and positive performance in terms of excess returns. I think what we'll do today is I'll start with the brief firm overview. I'll just kind of reset, remind you guys of who we are, and then my colleague Chris Zani, who's a portfolio manager for PGIM Quantitative Solutions here, he will take you through our philosophy, our process, and then we'll go through performance and attribution, which is, I'm sure, what you really want to get to at this point in time. I'll start. I'm Pat McMenamin. I've been with PGIM Quantitative Solutions for about 7 years, and all that time I've been one of the relationship managers for the Mendocino County Retirement Association. So we are PGIM, and as you'll see on the slide up here, we are a $1.5 trillion asset manager. We are a wholly owned subsidiary of Prudential Financial, which is the large financial services and insurance company based out of Newark, New Jersey. We are also Newark-based. If you look on that upper left-hand corner in that blue chart, PGIM manages about $269 billion in equity strategies. And that is two business units are responsible for that. One is Jennison Associates, which is our fundamental, which is a fundamental manager within PGIM, and the other is PGIM Quantitative Solutions, which we're representing today, and which is the asset manager for the small cap value product that we've been managing for these past few decades. If you can go to slide 5, I'll zoom in a little bit on PGIM Quantitative Solutions. So of that $269 billion number that you saw on that previous page, $111 billion of that belongs to PGIM Quantitative Solutions in that business unit. You'll see that assets are roughly split evenly, about 50-50 between quantitative equity, where the small cap value product sits, and multi-asset, which it's basically that's where we invest across multiple asset classes, not just equity, inclusive of equity, fixed income, things like real assets, commodities, and that's a large part of our business as well. But small cap value sits within quantitative equity. You'll see sort of on the bottom of that pie chart right there. These are the different strategies that we run. So we run actively managed systematic quantitative strategies across U.S. and non-U.S. products. We run it for all market caps within the U.S., so that's large cap, mid cap, small cap, even micro cap. And then on our non-U.S. strategies, we run global mandates as well as emerging market mandates, as well as European specific mandates, as well as single country mandates. So we've been doing it for 50 years. And I'm happy to report that really I saw a number this morning that about 90% of our strategies are exceeding the benchmark for that trailing 1, 3, 5, and since inception number. So it's been a good time for the platform. If you could just briefly go to slide 10.
We have a question?
Sure.
Yes, going back to the first slide or so,
Sure.
Could you elaborate on what are the alternative investments that you're making?
PGIM, more broadly, if you can go back to slide 4, the alternative mandates we have a private credit, we have a direct lending business, we have a private credit secondaries business, and we have a multi-asset business that focuses more on private markets as well. But PGIM Quantitative Solutions, which is the group that you're talking to today, really focuses on the public markets. So not private or alternative investments. We don't do hedge funds. We are doing publicly traded equity and across the multi-asset space, sometimes fixed income, commodities, and publicly traded real estate.
Thank you.
Sure. So if we can go back to slide 10. This is just, again, a snapshot of all of our products, and so I'll point out that if you look down into the middle of the screen under U.S. value, you'll see U.S. small cap value. So these numbers are as of 12/31. You'll see we manage about $380 million in small cap value products now. The value suite, which is inclusive of large, mid, and small cap, is in excess of $1 billion. And then you'll just see some summary statistics there for small cap value. We've been managing the small cap value strategy since 2007, and the typical holdings range in that strategy is about 275 to 375 stocks. So, any questions on that intro?
Seeing none?
Great. So I'm going to turn it over to Chris now, and Chris will start by providing a few brief comments on the team and the investment team, which he's a major part of. And then he'll talk about philosophy and process. He'll touch on research, and then we'll get into performance and attribution. Thanks, Chris.
Great. Thanks, Pat. Perfect. Slide 12. So the team itself, again, 60 investment professionals. We're all based out of Newark, New Jersey, just south of New York. It's an extremely experienced team, so we have an average of 18 years of experience. A lot of us have been through the tech bubble, the global financial crisis, Brexit, COVID. Understanding how the model reacts in those markets becomes very important. A lot of us have been there for quite some time, so the average tenure is 12 years at PGIM Quant. So we've worked together. I think that speaks a lot to the collaboration of how we interact on a daily basis. The team is led by George Patterson, that you'll see up top. George has been in the industry for 40 plus years. He was at Barclays Global, based out of San Francisco back in the day. Worked as the CIO of BMO, and before we dragged him over to the dark side, he was a rocket scientist for NASA. So when we're looking to expand our team, we're looking not just across finance and economics, we're understanding the hard sciences, computer science, understanding if you can look at data and do research, the data that you're looking at can be somewhat fungible. And so we're really looking for just smart people that understand how to do research. The portfolio management team is in that light blue section on the left-hand side. It's led by Stacy Mintz with over 35 years of experience. I'm one of the 14 portfolio managers on that team. It's a team-based approach, so opposed to maybe some of the other managers you might interact with that has a specific lead portfolio manager, we really manage this team as a strategy. It's about how does the model translate into the portfolio. So we're focusing on making sure that the model is representative, but there isn't one necessarily lead PM. It's really well backed up across the board. There are,
you have a question?
Just out of curiosity, you of course mentioned not just looking for one pool, but can you elaborate a little bit of the 80 advanced degrees, somewhat that spectrum?
Yeah, I would say it's, there's certainly going to be some finance and economics, then going down from a research perspective, computer science, and then the hard sciences, physics, chemical engineering. Those are sort of the other places where you can take research principles and translate them to what we do.
Statistics?
Of course, yes. I feel like statistics, if you can't do statistics, that's a non-starter.
Thank you.
The research team, just briefly touching on that, we have 25 researchers and investment architects. So that's a combination of people that are looking for new ways to interpret data sets, new techniques. Certainly AI has been a big theme. That's where that comes in. And then making sure that system runs on a daily basis. So creating proprietary systems, creating tools that we as portfolio managers can use to more efficiently run these strategies. If we go to the next page, the philosophy, how do we think about the world? How do we choose stocks? As Pat said, I call it systematically fundamental investing. A lot of words, what does that actually mean? Is we think like a fundamental manager. So you probably have plenty of fundamental managers managing money on behalf of the pension. Those are people who meet with management, who come up with models and come up with opinions on stocks. We want to think like those fundamental managers, but we want to do so in a very systematic, very disciplined way. And so as we know, there's a big corpus of work called behavioral finance, and this is understanding the errors that we make simply as humans. It's only looking at information that confirms our own biases. It's looking only at shorter term information. And so why we use a quantitative or systematic framework is try to avoid those behavioral errors. So we want to think, oh, go ahead.
What would you define as short-term price deviation?
Perfect. Great question. So we tend to think shorter term is maybe 6 months or less. So the turnover of this portfolio is about 100% per year. So we want to be holding stocks for roughly 6 to 12 months. So we don't want to be overreacting to shorter term, maybe call it 1 to 3 months. We want to be looking over a slightly longer horizon. And so one of the tools we use as portfolio managers to avoid some of these biases is an optimizer. And so the process that I'll get into on the next page is really following, actually skip 2 pages to page 15. So every day when we're looking at, in this case, the small cap value universe, a universe of 2,500 stocks, we're going to put it through our model. And what our model is going to give us is a ranking of stocks over the next, let's call it 6 to 12 months. We then use a portfolio optimizer risk model and understanding how much it costs to trade in and out of these names to figure out what the optimal mix of that portfolio is. And so that is having a tool to really understand and be able to avoid some of these behavioral errors that investors tend. Portfolio managers review those trade lists. So usually we trade roughly about once a week. We check those trade lists to make sure that the model and the market are in alignment. And we execute those trades, usually takes about 1 day. So we don't want to be demanding a lot of liquidity. We can understand that what the demand is and make sure that we are very careful about how much we're demanding. And so the model is highlighted on the next page. And as I was starting from left to right, we're going to look at as many small cap value stocks as possible. It's a large universe, 2,500. We're going to be looking for metrics or characteristics of stocks that can be characterized as certainly value characteristics, growth characteristics, and quality characteristics. Generally speaking, we want stocks that have positive attributes to all 3 of those. Stocks that look positive on a relative value, so recognizing that it's important the price you pay for a certain asset. We want stocks that are positively growing and stocks that have a positive quality of balance sheet. We'll get into attribution in a little, but quality I think is one of those examples that sometimes high quality stocks don't do nearly as well. And 25 I think was a good example of that. We recognize that over the longer term that tends to pay off, but sometimes quality is not necessarily what you want. And what that gives us essentially is a singular stock ranking, and we use that to then build the portfolio.
Chris, I have a preview question for you here. Usually when we talk about factors or we're looking at these factors, growth and value are sort of on opposite sides of the spectrum. You're calling out shallow and deep value on this page. But I noticed that the portfolio, and this is we're going to see this farther down the slide deck here, but I noticed that the portfolio is overweight cyclical growth sectors. And so my question really is all those things, which we're going to see when we look farther in the deck here, is about some of those sectors and how your value screen really works in relation to like your healthcare and IT sector, for instance.
Yeah, I mean, the interesting thing about that is, so when we go to build the portfolio, we might be marginally overweight certain sectors, but that x-axis scale is super tight. And so maybe if we just jump ahead and I'll come back to look at page 25. being plus or minus roughly 2.5% at time of rebalance. So we might be shifting a little towards those on a relative basis, but I think financials is probably a good example. It's the largest relative underweight, but it's still the largest weight in the entire portfolio from an absolute basis. So we want to be finding these value opportunities, but in this case, we're finding more value opportunities within maybe some of the more pro-cyclical sectors because it has a lot of those simultaneous characteristics, not just value, but value that are growing that has higher quality. So from a stock evaluation process, that's really what we're looking for. We're looking for, it's a value benchmark. We're looking for value opportunities that are also growing, that also have higher quality. If you might have heard the word GARP, or growth at a reasonable price, that's essentially what we're looking for.
I'm sorry, what was that term?
GARP, G-A-R-P, growth at a reasonable price.
Ah.
So with that, maybe let's just jump, I may just jump quickly to page 20, just talking about our research. So we're always looking to find new and interesting signals that maybe either compute power has allowed us to now access, or using AI in a very constrained sort of way allows us to find new signals that might not have been there before. So the research process is always trying to find newer ways to access information, access compute that we might not have had in the past, that allows us to be consistent with our investment philosophy, but finding new pieces in the future. So we're always looking for new ideas. We're always looking for new data. And then from an AI perspective, how we tend to use it is to understand unstructured text, or in this case, think about reading corporate transcripts. So let's say Microsoft, for example, has an earnings announcement. We can use natural language processing models to understand, is the CEO of Microsoft, are they more or less positive than they have been over a trailing 12-month basis? So that's one of the examples of sort of new techniques that are now available that maybe weren't available to us 5-10 years ago.
Yes.
Could you elaborate on persistent validity and expected decay?
Yes. So part of that, I think, goes to, one of the questions you asked about short-term versus long-term. So, there's some pieces of AI that are really, really interesting. Pattern recognition, that kind of thing. That tends to decay a lot faster. And given our investment philosophy, given how we invest, that's probably not a good tool to use in our toolbox. So we want to look for signals that have persistence, let's say 6 to 12 months, and that don't decay so fast that we would have to considerably turn the portfolio over a lot more. So that's one of the things we look for when we're looking at signals. Something might look really great from a statistical standpoint, but it doesn't align with our investment philosophy, that probably gets thrown out.
Thank you.
And so maybe if we head to page 22 and get into the performance, maybe focusing on that trailing 1 year as of the end of February. So on a net basis, the strategy added 2.6% or 2.58% of relative outperformance. So the benchmark being up almost 25% on a trailing 1 year basis, and we're up 27.5%. We're doing it and making sure that we're managing the risk of that very carefully. And that's where the information ratio comes in. What that calculates very simply is the active return, in this case 2.58, divided by the risk you're taking, or the tracking error, in this case 4.55. So from an information or IR standpoint, we want to understand and be essentially in that range of per unit of return, how much risk are you willing to take? And usually for these types of strategies, 0.5 tends to be a long run average. So last year at 0.77, we're pretty happy with that, adding value per unit of risk.
Could you repeat the definition of information ratio, please?
Sure. It is active return, or in this case, if you look at net alpha on the left-hand side, divided by tracking error, or another way to say that is active risk.
Thank you.
So the attribution is on the next page, breaking down some of the sectors where performance was coming from. And I would say thematically, what we saw in 25, generally speaking, was the ability to pick stocks in the face of, I would say, a more of a macro type environment where we saw a lot of focus on quantum computing and AI. And that brings me back to that quality idea that some of these stocks that we'll talk about in technology and in healthcare did really well on the baseline of the future potential of AI that didn't really have earnings that had a low quality of balance sheet. So sometimes that happens. It usually doesn't add value over the longer term, which is why we believe in higher quality companies. But I think in 25, that's an example that we saw was detraction coming from technology, mainly from companies that used to be mining Bitcoin and are now shifting and pivoting to AI and leasing their space out to Amazon and Microsoft that didn't have very good earnings, but they did very well. So that thematic concept, I would say, kind of carried through in 25.
Yeah, and just for trustees, I want to point out a couple things that is interesting about this slide. So this is a good slide in my view. Now it's a short time frame; it's the last year, but it shows a few interesting things. Number one interesting thing, I think, outside of the high performance over the last year, right? We know the strategy's done really well. We saw that in the last quarterly calendar report, but the allocation versus the selection effect is really important for us. This is something that we're expecting to see when we look at an attribution analysis like this. We're expecting the allocation effect is going to be very low, potentially negative, and we're expecting that the selection effect should be high, just like we're seeing here in total. And you know, the other thing that you can kind of go through and look at on a slide like this is the actual weights of the strategy versus the weights of the index. Now, I have a lot of opinions about what particular benchmark is the right benchmark for any given strategy. But that aside, you can still go through here and look at the relative weights where the strategy is deciding or finding relative value. And we can see that the industrial sector there has a relative active weight of 3.58. So that's, I view that as they're leaning in and they're finding value there, right, through their process. In terms of actually looking at the breakdown of the allocation to selection effect, when I look at these types of reports, I'm always looking at, well, what didn't work? It's nice when things do work, and a lot of things worked out, but I'm sort of more interested in when things didn't work out and how is the strategy either mitigating that or reconsidering that. And so when I look at this particular report, which is why I was alluding with my question earlier, the IT selection and healthcare selection are negative. Now, overall, the total portfolio has done an outstanding job over the last year time frame, but those two are standing out because they're quite large. And so, you know, I guess my question to PGIM here is, you know, can you talk about the maintaining the overweights in those particular sectors when your security selection is somehow not able to capture any alpha there?
Yeah, I mean, I think what Robert's pointing out is absolutely spot on. When you're talking to managers, understanding how they think about the world will come through on this type of report. And so, as we talked about being a bottom-up stock selector, you want to see most of your alpha or most of your outperformance coming through on selection. So because we're not taking very large active sector bets, allocation should be small. So that should be something you're looking for just in general. From to answer your question specifically, I think a lot of this comes down to risk management. And so sometimes your alpha model, your ranking model works really well in some areas and sometimes it doesn't. And what we saw in 2025 was not necessarily the model negatively contributing from an IT, healthcare, and material standpoint, but it was mainly the names we didn't own that contributed negatively on a relative basis. So for example, in IT, a lot of those quantum computing names, the data centers, so names like Hub 8, Cipher Digital, those were up over 200%, which we did not own. Partly coming through on the quality aspect. So it was really not a function of having negative, picking our stocks not performing. They just didn't perform as well as some of these lower quality stocks.
So I guess that's also reflected if you look at the benchmark total return there. So if you look at IT tech total return within the strategy, 34.81 versus index return of 54.10. And you can kind of see the same thing in healthcare there.
Yeah, and healthcare was, healthcare tends to be an area of what, especially in small cap value space, what smaller cap companies have FDA drug approvals that got approved. And so, in this case, there are a couple, like Praxis, for example, was up 700% because they had a seizure med that was approved by the FDA. We tend to take smaller positions in healthcare, so we're going to own a lot more because getting those right can be very difficult. So sometimes those names go one way, sometimes they go another way. We want to manage that risk effectively. And the materials was that was just underweight to gold. Gold was up huge amount in 2025 as investors were questioning geopolitical issues that were going on there. So you saw a lot of gold miners do extremely well there. And again, we're taking, we own 400 some odd names in this portfolio. We're taking very small individual active exposures, and that's how we manage that risk.
Yes.
To what extent do you maybe even look for the stocks that present their earnings in also a non-GAAP earnings as maybe a warning sign that they're trying to massage it too much?
Exactly, and so that usually comes through on our quality of balance sheet. So there's a factor out there that came out of the Enron scandal in 2005 called Sloan's Measures of Accruals. And so that essentially looks at the income statement and understands how much should you make, or you're reporting on an income statement. And in theory, that should flow over to your cash flow statement, just on a normal accounting basis. And if there's monkey business to be played, it usually gets played there. So the accruals measure essentially looks for those questionable issues that comes through on our quality measures.
Thank you.
So we only have a few more minutes here. Can we flip forward to page 24? There was two things I wanted to at least mention or point out to the trustees. This is a pretty standard slide here where we can see the market cap exposure of the strategy versus the benchmark and different valuation metrics, some of the holdings, the 400 plus holdings that Chris alluded to. One thing that sort of stands out to me, again, just if you're thinking about the valuation metrics here, if I'm thinking that this strategy is deep value, small cap deep value, I'm sort of surprised that the price to book ratio is a 1.5. And now I know that that's changed quite a bit over the last year. But can you kind of, for any trustees that might be looking at that wondering, can you kind of talk about that, and I'm alluding to another question based off of slide 26 that I'd also like to point out to trustees. So can you mention that PB 1.5? That's high.
Yes, on a absolute basis. So I think maybe slide 20. Well, you know what? Let me go back one to slide 17. Sorry to make you jump around like that. And so when we're looking at value, we want to be looking at value both from what we call maybe an operating value or shallow value. That's looking at the income statement. How much money are you making on a trailing basis relative to your price? And then as Robert was talking about deeper value, how much are you paying for the assets of a company? What we find with deep value is that it tends to work mainly on inflection points and not tend to work anywhere else. So price to book, for example, is one of those factors that when the market is really shifting, I tend to think, I always remember in 2008 or March of 2009, coming out of the global financial crisis, Citi trading at $3. Their price to book was huge. That's when price to book really, really mattered. And so we're going to look at that and understand that spread, and the wider the differential is, the more we're going to emphasize price to book. And so what you're seeing in a characteristics basis is that right now that spread isn't wide enough for us to really focus on price to book. Instead, we're going to be focused more on the income statement definition of value. As that spread widens, as more fear and uncertainty moves into the marketplace, you're going to see more of a shift into price to book at the expense of, say, price to earnings.
Great, yeah. And so going to slide 26, just for the trustees, you can see that the strategy is sort of floated around 1, in 22 it goes down below 1, and then it sort of gradually ticks up, and now it's kind of in the box. So that to me is something where I look at that graph and I go, oh, that's very interesting. That's not necessarily what I would have expected. Just knowing that it's a deep value play. So I appreciate the clarification on that.
Were there any other questions you had about that characteristics page that you'd like to dig in on?
Well, I would again mention to the trustees that, one of the metrics that I've found to be impressive for this strategy is the EPS growth. So not even just here, but on this particular slide, the 3.9% versus the negative on the benchmark. It's actually, it's even high compared to peers. So that's a good thing. Now we do know that growth in value can go in and out of favor, which is why we have both of them, right? Because one does good, one does better, but we sort of expect capital appreciation to go up on both sides in the long term. But EPS growth is a huge driving factor for the price of a stock if you're looking at an individual stock. So knowing that number is high relative to the benchmark and to peers, I just want to point that out for trustees. I didn't have any other thoughts or comments.
Thank you guys for having us today.
Thank you very much. Is there any questions overall for the panel? Nope. Okay. Thank you very much.
Thank you. Appreciate your time.
Thank you.
Have a good day.
I have a question.
Sure. Sorry. We got a late question.
There's always that guy.
So with the whole thing in the Middle East and the Iran war and all that, how does that affect your thinking on this?
Great question. So as a systematic manager, we want to be disciplined. We talked about not making behavioral errors, right? But at the same time, we as portfolio managers need to recognize that sometimes the models are not understanding what's going on. And so to me, it's a very simple question we ask ourselves. Is the model and the market in alignment? So for example, March 3rd, bombs start going off in Iran, our model doesn't know that geopolitical risk is happening. And so what happens for us in that situation is we'll work with our CIO and our head of portfolio management to say, does it make sense to deploy capital to trade when this is going on? And so what we found there was, I think for our US strategies, we probably didn't trade for a good week. Markets were hugely volatile. We were waiting for the market and the model to catch up with each other. And so that's how we tend to interpret these big type areas, because one tweet can send the markets one way or another. We try not to play that game, but we also need to be recognizing that sometimes your models are not current and they need time to interpret and catch up with the information. So when those huge events happen, they don't happen very often, but when they do, what we want to do is give the model time to catch up. So we won't trade unless we absolutely have to trade.
Well, and before you go, Trustee Swope, I would point out, and we can see this later, in the month of March, this strategy lost 3.25% roughly, which is not a whole lot, which is relatively low. So one read of that comment from Chris is that the strategy was relatively unaffected, considering something like what happened in the international strategies, right, down 10% or 12% in EM. So, and that's sort of something we would expect if you just were saying, I would expect a value strategy to be less volatile. Now, this is small cap, but on a relative basis, we can see in the monthly report that it was relatively unaffected.
When are you making significant changes to the model?
Great question. How we tend not to make significant changes, but we are always updating the model. So when the research process basically works is we'll set our research agenda. We will basically evaluate those research projects over the course of a year. Once we feel like, it's going on right now, once we feel like we have a collection of newer factors or new modulations that we want to make, we'll test those out. So right now, for example, if I'm rebalancing a portfolio, I'll rebalance with our current rankings, and then I'll rebalance with the new rankings, just keeping an eyeball on it, making sure it makes sense. We'll usually implement those once a year, and the correlation of those models tends to be somewhere about 90-95%. So you don't want to be making huge wholesale changes and burning a bunch of turnover every single year. But if I look at the model 5 years ago, it may have a 2/3 correlation. So you're making small incremental changes every year and then productionalizing it usually about once a year.
Thank you.
Okay, any further questions?
Really appreciate your time today. Thank you so much. Thank you very much.
Enjoy your beautiful drive back.
Oh, we will. Looking forward to it.
And do we, does anybody, it's 10 straight up now. Would anybody like to take a break right now? Okay, let's do 10 minutes before we start with item G. So come back at 10 after 10, please. Are we ready to get back in?
Yes.
Okay.
Let's see, we just need to let Jeff back in.
I'm good.
Jeff, can you hear us?
Stop too.
Can you hear us, Jeff?
Trying to make sure you got room.
Pictures?
I did. Yes.
Alrighty, we are back in session, and we're on item 5B, fixed income structure review, Claritine, and, well, I'm seeing Greg, but it says Hannah here.
Does it?
Okay, and Greg.
You've been downgraded today.
All right.
There we go.
All right, great. Importantly, as was just mentioned, the purpose of our discussion today is to focus on fixed income. So as you all know well, over the last few years, we've been working through reviews of each asset category included in the portfolio. And we've gone through U.S. equity, non-U.S. equity, real assets, so real estate and infrastructure, and today, again, we're talking about fixed income. So our goal today is to start off reviewing your fixed income portfolio. So spend some time talking about what we have today, how we implement the fixed income portfolio, who are the managers that we use in the fixed income portfolio, who we invest with, how do they fit together, what do we think of them? They've been in the portfolio for quite some time. And then we want to spend some time discussing, fixed income more broadly. So let's take the opportunity to, discuss how, fixed income fits into the portfolio, the role that it plays in the portfolio, what we're looking to the fixed income portfolio to do. And then we're going to finish the discussion by talking about, other implementations. What do others do? What could we think about doing differently? And what would those bring to the portfolio? And why haven't we done those different implementations so far? So that's the plan for today. I do want to note that Greg, Hannah, and I are here. Hannah's online, but we're also joined by Dario Bucci, who's a member of Callan's fixed income research team. So he spends all of his time researching fixed income, talking to fixed income managers. He is an important internal expert at Callan, so we're glad to have him join us for the discussion today. So we're actually going to start out of order in this presentation. So if you'll bear with me, we're going to start on slide 24 of the PDF.
23.
Got to get myself there too. Okay, perfect. Thank you. So again, just to start off with, what do we have today? Where is fixed income in the Mendocino County portfolio today? So on the left-hand side of this page, we have the current total portfolio target. The light blue slice represents our fixed income allocation. So it's a 21% allocation. And another way to think about that is that means that 79% of our strategic target is with more growth-oriented assets, so equity and real assets, real estate infrastructure. That light blue slice of the pie, that 21%, is implemented with the second pie chart on the right, implemented with two managers. We use Dodge & Cox and PIMCO as our two active core plus bond managers in the portfolio. Again, both actively managed portfolios that make up our fixed income allocation. Now I mention that because that's different from how we've chosen to implement the equity allocations, the U.S. equity and international equity allocations. As you know, we allocate a significant portion of each of those to a passive index fund and then are more selective with where we take our active risk within U.S. equity and non-U.S. equity. And the entirety of our fixed income portfolio is implemented with active management. And we think that's a good choice. It's worked out really well. There's reasons for that, and we'll talk about that later in the presentation. So this is what we have. It's frankly pretty simple. It's intentionally simple. That's on purpose, and these two managers have done very well. They've provided return net of fees They provide diversification to the equity portfolio, and they're also diversifying to each other. So that's where we're going to start the discussion today.
Trustee Swam?
How would you describe the investment, the fixed income investment philosophy of Dodge and Cox versus PIMCO?
Great question, and that's where we're going to start today. So before we get there, if I can, the last thing I want to mention on this page is that we do note kind of the bottom half of the page, that 21% allocation does represent about $176 million in total. Split evenly between the two managers, and then we show the fees on here for the two managers. Now, importantly, all the returns that we look at are always net of these fees, but do want to highlight these fees and also highlight that as part of this kind of ongoing discussion, one of the things that we look to is, is there cheaper access to these strategies as new vehicles and new minimums, new vehicles are introduced and new minimums are hit. So just to hit on that quickly up front, Dodge and Cox, currently a mutual fund. This is the cheapest access for the portfolio. PIMCO, also currently a mutual fund. There is actually a collective trust access to this same strategy that would be at a pretty significantly lower fee, 20 basis points versus 46. So that's something that we've been working with Robert and PIMCO on. I know Robert spent some time reviewing the subscription documents. We think it would likely make sense to move forward with this lower cost vehicle access to the strategy, but do want to make sure that there's been full due diligence in advance of making that move. So, Robert.
Yeah, so I just want to say that it does have different allocations and maximum and minimum risk limits for the strategy. So the strategy is it's similar, but it's different. It's different enough that I'm like, hey, no. We need to do due diligence on this strategy really before we actually move forward. In addition to the different return characteristics, which it's more conservative, right? Broadly, it's more conservative. So it's going to have lower returns and lower volatility associated with it, which you guys know me. I love low volatility. That's great. Sounds really good. But we haven't really looked at if that's exactly what we want to do. And I think we're going to get to that. Trustee Swope question is alluding to, what are these strategies? How are they approaching their fixed income universes? So we're going to talk about that a little bit. So there's risk considerations involved in the CIT that are more conservative. In addition to that, there's also other reporting requirements and things related to issues related to like our conflict of interest policy, placement agent policy, jurisdictional issues. So there are other concerns. I shouldn't say concerns, but there are other items that we want to address through a side letter process. So basically at the end of this presentation, what I would ask is for direction to continue doing that due diligence on the CIT. And I'll ask that again, but that's just a preview of what's coming up, right? I don't think there's any harm in doing the due diligence on that.
So if I could just ask a quick question. There's another, you're saying there's another investment offered by PIMCO that is half the fees?
Another vehicle.
Another vehicle?
Another vehicle.
Another vehicle offered by PIMCO that is significantly lower in fees, and that's what you're talking about. You're not talking about shifting that? Okay.
Yes.
So that would be we would go through the same process as we would with selecting a complete manager, wouldn't we?
Well, not the entire process involved in that, but we want to have our eyes wide open in knowing that the CIT has some different risk characteristics than the mutual fund vehicle. Okay.
What does CIT mean?
Is a collective investment trust. It's like a bank strategy offered to non-retail investors. So they're generally cheaper. We've got CITs in the portfolio already, right? So it's not the vehicle that is special. It's just the different risk considerations that the strategy employs.
Same overall broad strategy, same team. Just a note to the board that you may hear more about potentially moving to that lower cost vehicle strategy.
What is the history of the alternative? I mean, how many years has that been in existence?
This CIT is newer. I believe it's come about in the last, this particular access in the last couple years. A little less than 2 years, I believe. So yeah,
Claire, I can jump in here quickly. This share class, this fee that we're talking about within the CIT is within the last year and a half, but PIMCO has been managing CIT structures for this strategy since 2009. So the vehicle itself is not new. This is the unit class, they call it, at this fee level that is newer.
Dario, could you give me a little bit of quick background on you? Just, I would appreciate it.
Yes, absolutely. Yes, so Dario Bucci, as Claire mentioned, I am a member of our Global Manager Research Group. So our group is divided across fixed income, domestic equity, and international equity. I fall within fixed income, and my entire role is knowing and researching the fixed income manager universe, and ultimately helping our clients select and monitor their fixed income strategies. I'm based in our Denver office, and I'm coming up on 9 years with the firm.
And this is probably a great time to transition to your original question and turn the floor to Dario to spend some time talking about your current fixed income portfolio, Dodge & Cox and PIMCO, and their performance together.
Great, so I can jump in here. We can flip to the next slide, slide 24. So I'll kick off here with just a kind of brief overview again of the structure, and then get into the individual managers being Dodge & Cox and PIMCO. And I absolutely heard the question earlier on the differences in philosophy, and I will definitely be hitting on that in this session here. So ultimately, what we're looking at with this structure is a high quality, actively managed public fixed income fund. Both managers have similar objectives to outperform the Bloomberg Aggregate Index, but they will go about that in slightly different ways. But at the crux of it, over a market cycle, these funds are seeking to out-yield the benchmark by taking measured risk. And that yield advantage that this fund has versus the benchmark is really evident in that top right-hand chart, portfolio characteristics towards the middle in that effective yield column, where you can see the fixed income fund out-yielding the benchmark by, call it, 1%. So how do these managers ultimately express these kind of measured risks to out-yield the benchmark? There's a few ways to go about it. These can be by taking more macroeconomic-based positions, or by expressing more credit-oriented positions. And your managers here do differ a bit in how they go about this, which I will get into. But this is also a key reason why we do feel that they pair well together. So I'll pause there quickly, see if there are any questions on that background before we get into a little more on the nature of the strategies themselves.
I'd like to point out for trustees, notice the benchmark exposure here versus the managers. You know, there's a slide in the start of the deck that talks about the benchmark, you know, and I want trustees to just keep in mind these different exposures, specifically look at the U.S. Treasuries for the portfolio versus the benchmark, and look at agency RMBS, right? Those are the real standouts there. Now, there's a few other interesting items too, non-agency RMBS, asset-backed. So just kind of be aware of that, right? We've also got CMOs in there. So notice that. Second, I'd like to point out to the trustees the top of this chart here with the effective duration, that the portfolio is a little bit longer than the benchmark, right? Just a little bit. So that's something we're going to talk about in a few slides here in the future. And then finally, look at the quality rating as well. Not probably the biggest issue. These strategies have been real stable with the quality issue at AA the entire time that I've been at MSERA. But again, just notice that the quality is less than the benchmark. The strategies have fewer treasuries, which sort of explains some of that, right? Why the credit quality is a little bit lower. And the duration is also a little bit higher. Those three things are kind of all playing together with each other. Back to you, Dario. Thank you.
Nope. Thank you. That segues well into my next point, which we can flip to slide 27. So honing in on Robert's point on credit quality and more just on exposures more broadly, it's important to point out that both these strategies, while they are high quality fixed income strategies benchmarked to the Bloomberg aggregate, they do have a degree being actively managed to take more opportunistic exposures to areas like high yield, non-dollar, potentially emerging markets debt. And those are really key levers for how these strategies generate outperformance over time. Now, that opportunistic nature, or call it tactical component, is a reason we like strategies like this, because they're able to take advantage of what is most attractive to them in the markets at any given point in time. And to put some numbers around this, using high yield as an example at the bottom of the chart here, just highlighting how these strategies kind of tactically rotate. Dodge and Cox over the last 10 years, when I looked at it, has gotten as high as 12% of the portfolio in high yield, but also as low as 4%, which they're at currently. This is an environment where many managers are not seeing as much value in high yield credit. So they will choose to reduce that exposure. PIMCO as well has gotten as high as 15% over the trailing 10 years, but now they are as low as 6%. So really highlighting the opportunistic nature of those exposures there, but also important to note, these strategies are bound by guidelines as well in your agreements with them. So they cannot put the entire portfolio in these more risk-seeking assets. Both of these strategies will be capped at an absolute level of below investment grade, somewhere in the realm of 20% of the portfolio. So there are those guardrails to ensure that they are not taking undue risk and still maintaining that high quality orientation overall. And then we can flip to the next slide, slide 28. Here's where I will get into really the philosophies and the processes of each manager and how they might differ and ultimately how they might pair together. So starting with Dodge and Cox, Dodge and Cox is a traditional, fundamentally driven fixed income manager with a particular expertise in corporate bonds. So they do deep fundamental research on companies. They take positions in these bonds and hold them for a long period of time, so display a high degree of conviction in them. And then other areas like securitized credit and mortgages are going to be more benchmark-like. So over time, for Dodge and Cox, we do expect their excess return to come primarily from that corporate credit area, and that is the key to their process. I'll also mention that we did, within the last, I would say 2 or 3 weeks ago, we as a team did an on-site meeting at Dodge and Cox offices in San Francisco, and that really did reaffirm our conviction in them. We think that this is the process and philosophy that will continue moving forward. So always good to see kind of another stamp on our conviction there. And on the organizational and team front for Dodge and Cox, one reason we do like them is they have a kind of broad committee-based structure for all their investments in order to be approved for the portfolio. So ultimately, we do feel that that mitigates key person risk, so to speak, by really disseminating investment responsibilities across individuals, which is a key component across really all asset classes at Dodge and Cox on why we view them as very stable as an organization and a team. So I can pause there for a moment, see if there are any questions on Dodge and Cox before we flip over to PIMCO.
You'll also notice the performance has been pretty exceptional.
Yes, no doubt about that.
Year by year as well.
Yeah.
Hey, Dario?
Great, so then we can flip to slide 30. So on to PIMCO, we can really contrast Dodge and Cox philosophy and process to that of PIMCO, which is why we do feel that these pair well. So PIMCO is what we internally call an all-weather strategy. They look to be diversified across their sources of excess return. So they will over time not be as reliant on, say, corporate credit as a Dodge and Cox. And they'll express more of their positions in areas like securitized credit and mortgages, and also potentially express more, call them macroeconomic views in the form of duration positioning. So overall, very diversified under the hood on where PIMCO is looking to add value. And that really dovetails into PIMCO as an organization. They have a wealth of resources across all of these sectors, including macroeconomics and the underlying bond sectors. So all of that is really rolling up into the Total Return Fund, which is one of their really flagship fixed income funds. So a very key piece to PIMCO's process is what they call their Investment Cyclical Forum, which is an annual company-wide meeting where they bring in outside policymakers and senior investors from all these different sector teams and essentially set a 12-month view on the economy that guides their positioning really for all of their fixed income strategies. So a wealth of resources on that front. So overall, when we're thinking about the roll up here, we have Dodge and Cox on one side being that really bottom up corporate credit oriented manager, taking those long standing positions in the corporate bond market. And then PIMCO being your more macroeconomic oriented manager, taking diversified risk across interest rates, mortgages, securitized credit, and corporate credit to a lesser degree. So those factors are really why we feel this is a effective pairing moving forward. And I can pause there. That is, sorry.
Trustees, the Dodge and Cox strategy is really mostly focused on the U.S. And PIMCO, while they are largely focused in the U.S., they're also looking at the globe. And they're looking at non-U.S. exposure. They have the ability to go outside the U.S. if they find something compelling. EM debt would be another example. So they've got EM debt. They have they do a lot of derivatives hedging, and if you look in the quarterly reports, you can actually see that on the Callan reports. If you look at their sector exposure, there's a large hedge in a constantly rolling hedge for the strategy. So that's part of the different approach. Dodge and Cox kind of a buy and hold, U.S. focused. The PIMCO strategy is more of a global, has a global aspect to it, and uses swaps and futures much more so. If you were to look at other metrics like turnover rates, that's probably the standout metric that shows you that, right? There's very low turnover in Dodge and Cox, and there's pretty high turnover in PIMCO. And that's because they're always rolling these derivatives forward all the time.
So then, putting this together, if we go back to slide 25, how have these two managers performed together? Slide 25 here shows the combined performance for the MSERA fixed income portfolio. That's the blue dot on each of those floating bar charts versus the Bloomberg aggregate. That's our core benchmark. And then the gray distribution over each time period represents a peer group of other funds' fixed income implementation. And what we can see is, again, this portfolio has really done very well over all of these time periods. In the last 1 and 3 years, really faring well versus other public funds fixed income portfolios. So that includes fixed income portfolios that are frankly more complex in their implementation, might have more kind of dedicated specialty allocations. And this more simple pairing of Dodge and Cox and PIMCO that has those allocations under the hood has fared well over all time periods.
Trustee Swope has a question.
When Philip Gross left PIMCO, was there a difference in management for their fixed income when he left?
Bill Gross, do you want to talk about?
Yeah, so Bill Gross left. Dario, how many years ago was it? It was a while ago.
2014.
Yeah, and he was unquestionably, he was the founder of the firm and the head investment guy. So when he left, it was material for them. And he also had a very strong hand on everything that happened there. One thing, so I've been following PIMCO for 20 some years now. To me, one of the hallmarks of their organization is the depth of the investment professionals there. You look at the number 2, the number 3 person, they can often be the number 1 person at a number of other organizations. And with the investment team that stepped up after he left, I mean, they've certainly proven that they're pretty capable and seasoned people. But when Bill Gross left, I mean, that was for the gossip rags in the industry. There was a lot of talk about it, and it was certainly very material at that time, over 10 years ago.
Did the style change?
I say in aggregate, no. They still have the top-down, bottom-up process. Yeah, but certainly, he was a pretty important person. I think they're probably a little more collaborative now than before, though. Sorry, Dario.
They are also now a little bit more, I would say, benchmark aware than they were under Bill Gross on the margin. I mentioned this at the top that we view them as an all-weather strategy, and they do have an eye on tracking error now. Under Bill Gross, we would see the portfolio swing a little bit more from sector to sector in shorter time periods. So on the margin, but overall, we think it's a more predictable return pattern now than it was under Bill Gross.
So again, I'm jumping in a lot here, but I want to point out something that I think is important. This slide is very interesting. And the most interesting thing in my view is the benchmark here, right? Notice that the benchmark is low, quite low all the time. And so we have a slide on the benchmark. I think we're going to get to that because I think it's an important way for us to gauge the relative performance clearly. But, this is, to me, when I look at this, I'm wondering about why is it so low the whole time, right? Just looking at that. And I know why it's so low, but I want to point that out for trustees, and I know Callan's probably going to bring that up. It's very interesting. And, I guess the other thing I'd notice is the box size. Look at the older box sizes. They're a bit smaller than some of the middle years here, the 5, 3, 1 year. Recently, looks like performance is compressing a bit, but quite low relative. But the boxes are larger in these wider periods. There's also reasons for that, but I just want to point that out for trustees to remember that fact.
So the taller the box being the wider the distribution of returns for that time period for the peer group. To hit kind of the summary conclusions on page 32, for this review, we think that your portfolio remains sound. So we're not recommending any changes today. As Dario went through, two-manager structure. We think both managers, or the two managers, Dodge and Cox and PIMCO, remain good complements to each other. The portfolio's done really well, and we think it serves the purpose that we look for the fixed income portfolio to serve in kind of the structure of the total portfolio context. So not recommending any changes, but we do want to spend the rest of our time today talking about the fixed income market more broadly, some of the points that Robert brought up, and also, again, that point of what are others doing. One thing we'll look at is private credit, which is something that other investors have talked a fair amount about lately. So let's jump to slide 2. Again, we're looking at fixed income, and we want to start with just a reminder of kind of the role that we look to the fixed income portfolio to play. What are we looking for out of this allocation? So again, it's a 21% allocation within the Mendocino portfolio. That means that the other pieces shown here, U.S. equity, non-U.S. equity, real estate, infrastructure, make up the other about 80% of our total portfolio. And overall, we really look to our fixed income allocation to be that low risk anchor. So the other asset categories we're looking to for growth in the portfolio. Fixed income, we want a return out of it, of course, but overall, we're looking to it to be our low risk anchor. And that's really what's detailed more on the next page. And when we talk about fixed income, again, there are some competing priorities or competing objectives really of what we're looking to the fixed income portfolio to do. So as I mentioned, we want a return out of our bond portfolio. We're not putting it in cash. But importantly, we need it to diversify the rest of the portfolio. So we want it to be our safety allocation, right? Downside protection and market stress. We're looking for, again, that diversification, diversifying complement to our equity, reducing overall portfolio volatility by having that allocation within our portfolio. And it's also a key, source of liquidity, particularly in dislocated markets. There's a significant income component to the return there too. So the next two charts kind of show that, demonstrate that purpose in the portfolio. So the first one on page 4 here looks at time periods when the equity market is down. So the blue bars represent returns for the S&P 500 index in down markets, negative market environments for equity. And one thing you'll note is that those negative returns can be meaningful. So some of these bars are, -5, -10%, others are -30%, -45%. The green bars show what the bond market did in those same time periods. So in most of these time periods, the green bars are positive when those blue bars are negative. That's, again, that diversification, that anchor to windward, if you will, in the portfolio. But importantly, not always. So there are two time periods here where both bars are negative. One in 1994. There was a surprise increase in interest rates by the Fed at that time, which led to losses in both the stock market and the bond market. That's just what we saw in 2022 as well, right? A sharp rise in interest rates, which caused negative returns for both stocks and bonds. So both can be down at the same time. It's not always true that bonds are up when equities are down, but in most of the time periods shown here, again, you can see that diversification of bonds providing a positive return when the equity markets are dislocated. And then on the next slide is another way to look at this, looking at historical return patterns, notably volatility. So here we're looking at rolling 3-year returns. Again, the blue line is the stock market, the S&P 500 index. The green line is the bond market, the Bloomberg Barclays aggregate. And you can just contrast the volatility of stocks shown here to the much steadier bond return pattern. Again, in the furthest right part of the chart, you can see that the green line can be negative, right? So that's, again, this is a rolling 3-year return. That's really fallout from 2022 when we saw the Fed dramatically increase interest rates, which drove bond market and stock markets negative. But the biggest takeaway here is that blue line, the stock market, we can see the higher return potential from stocks achieved in most time periods, but it goes up and down quite a bit. And the predictability of the green line is that steady, more steady bond return. It's a tighter range of returns that we expect from bonds. So how do we structure a portfolio around this role? Importantly, we start neutral to the broad market. So when I say that, I mean the Bloomberg Barclays aggregate, the benchmark we keep talking about. It is really kind of the S&P 500 index of the bond market. It's meant to be a broad market representation of investment grade bonds. So we structure our portfolio around that index. And importantly, we're one slide ahead here. We want to ensure that it remains high quality for, again, those flight to quality environments. So I'm on slide 6, moving to slide 7. Perfect. And as Robert noted, here we just kind of highlight what that index is, the Bloomberg Barclays aggregate. Again, it represents kind of broad investment grade bonds, the broad investment grade bond market. It's widely used as a benchmark or proxy for the core investment grade bond market. We have a pie chart that shows what's included in it. It's treasuries, corporate bonds, mortgage-backed securities. What that also means is something that Robert pointed to is what it doesn't include. It doesn't include high yield bonds. It doesn't include non-US bonds, bank loans. Some of the kind of areas of the PIMCO and Dodge and Cox portfolios that we talked about as being out of benchmark, so areas that they allocate to hopefully achieve alpha over time. Another thing to note about this benchmark is that it is market cap weighted. So the largest issuers have the largest index weight. That's really what drives that treasury allocation, being 40% of the benchmark. But that is also where your active managers can allocate their risk budget. They tend to underweight the treasury allocation to take risk within corporate bonds, high yield, EMD, depending on the manager.
Got a question?
Would you define what agencies are considered?
Yeah.
So treasuries are obviously debt issued by the U.S. Treasury. Agencies are debt issued by entities like Fannie Mae and Freddie Mac, Ginnie Mae, to run their operations. It is not the mortgages that they actually issue. It's for them to run their operations, Fannie Mae, Freddie Mac. Now, the MBS, that stands for mortgage-backed security, those are the mortgages that are issued and securitized through Fannie and Freddie. So that's the agency pass-through mortgages is kind of like the jargon of it. But that's if you and I have a mortgage and it's originated by someone, Fannie or Freddie buys it, and then they repackage it into a mortgage-backed security. And that's what the MBS is. And then corporates are quite literally debt issued by a corporation. So IBM, GE, they'll issue debt. Everything in the index are they're fixed rate, no floating, 1 to 30 year in maturity, all investment grade, and all issuance sizes have to be, I think it used to be 250 million, maybe it's 500 million now, I kind of forget right now. But those are kind of like the key criteria for the creation of this index. There's also another sliver in here. It used to be about 5% of the index and it's become smaller as a percent of the index over time. And those are called asset-backed securities. So that would be something like auto loans or credit cards or home equity line of credits. So there's like this securitization process. When you go to Toyota and you buy a car, you'll borrow money from Toyota Motor Credit, and then Toyota Motor Credit then issues a bond that is essentially allowing you to borrow money from them. So that's where they get their financing for that. So there's another component called asset-backed securities. And when you look at some of the portfolios earlier, you saw that PIMCO and Dodge and Cox, they have this thing called ABS. That's the sort of thing that would include. Yeah, the bond market is very detailed.
there are a lot of like little slivers in it. Once you dig under the hood, it can get complicated pretty quickly. Leonard, did that address the question? Okay.
So it's not a perfect investment, certainly has limitations, but again, is, we think, a good benchmark. It's kind of a good starting point, again, neutral to the broad market, that this is a good representation of the broad market. And you know, some of the limitations are why we don't invest passively either, and we'll point to that on the next couple slides as well. So one slide forward.
So real quick, can you just go through those limitations? Because I think this is a big thing to remember, is that this is a, you know, very particular type of benchmark that doesn't include most, I don't know if I should say most, but a large opportunity set for our managers. Right? That treasuries are overweighted, right? That depending on how you want to look at that, that's maybe potentially more interest rate sensitive as a subsector, maybe. The fact that this is a market cap weighted index in terms of companies that are issuing debt, right? More companies are issuing debt, they become a larger part of the index. That's almost the opposite of like the equity indexes. That equity indexes can grow and companies can grow because they're doing better, their price is going up, right? So that's an issue. The liquidity factor is another issue that Callan's highlighting here, that these, once a lot of these, now not the case for treasuries and agencies and MBS, but for corporates, once some of those bonds are issued, they're off the market and there's no more on the runs, that's it. You might have a hard time selling them. But I think the biggest issue, in my view, is the narrow opportunity set. This is a investment grade, and that's a good thing. That's not bad. It's just narrower set than the entire fixed income universe. I just want to underscore that.
Are there competing indexes that have floating rates?
Oh, yeah, there's an index for everything. But this is like the broad universe that you'll see. So the company Bloomberg used to be called Barclays, and then it used to be called Lehman, and then before that, I think it was it Salomon or Shearson Lehman? Shearson Lehman. And so, you know, they've been making indices and for decades and decades, and they do have like different slices, some of which could be floating rate and that sort of thing. The way I look at this investment grade index is it doesn't necessarily represent every single bond in the world, let alone every single bond in the United States. If you look at the global bond market, it's about 40% US, 60% international. But you don't necessarily want to buy all those international bonds. They have a higher duration, currency risk, and a lower yield. You don't want them, right? And for the US-based bond investor, to me, this is more a definition of what home base is, of a neutral risk position, as opposed to everything they could buy. Now, if you put everything they could buy in an index that included high yield and bank loans and emerging market debt, well, that would just make your starting point riskier. And what's the active bond manager do to beat that index? Well, they then go overweight risk factors relative to a riskier index. So you could, there is something called the universal. The universal index includes below investment grade debt. But if you use that, one, the mutual funds out there aren't benchmarked to it. You could say it's the index, but it's not what you're investing in. And the other thing is you're just increasing the rate of speed that they're going to run. So what do some drivers do?
What do some drivers do when you're driving down the road and the speed limit's 55? How fast do you drive?
I'm not going to admit that.
Some people out there might drive 59 miles per hour. There's some of you out there that might do that, but are you going to drive 80? No. Some might.
Coming back from lunch, yeah.
Yeah, but what if the speed limit was 80? How fast are you going to drive?
100.
Yeah.
Exactly. So to me, yeah, there are flaws to this index, but it's the speed limit. And if you just increase the speed limit, someone's going to drive faster than it to try to beat the speed limit, right? So there are flaws, but that one thing to keep in mind.
Well, and that's what we see in the performance slide is exactly that.
Exactly.
That is
Yeah.
exactly what we see on the performance slide that we just looked at.
Yeah, exactly.
Which segues perfectly into slide 8. Building a bond portfolio benchmarked to the Bloomberg aggregate. How can we do it? Well, there's 3 key ways that we can consider doing this. So one is passive, top left. What do you get with a passive investment? It's low cost. You know what you're going to get. It's all investment grade. But of course, no ability to add value in less efficient markets. So you're getting certainty, but you're giving up potential for value add over that imperfect index. Bottom left, active core, gives an active manager some leeway to add value over the index, but generally those active core strategies stick pretty close to at least the sector allocations given to them with the benchmark. So represented by the Bloomberg aggregate. So active management, but with pretty tight guardrails. And we have Dodge and Cox that kind of fits into that bucket, though, per Dario's overview of the Dodge and Cox strategy, they're kind of a conservative core plus strategy, really. They do have some high yield, for example, in the portfolio. And then on the far right, core plus strategies, that's for us, PIMCO, in this portfolio. Gives managers more latitude to invest outside of the index, potentially add more value over the index. And I think per the description of PIMCO, their top-down allocation, higher allocations to high yield, emerging market debt, those things all make them very firmly a core plus manager. So those are kind of the 3 different ways that we can implement. And as noted, we don't implement with any passive management in the portfolio, right? Dodge and Cox and PIMCO, both all active and for good reason. A lot of those reasons have been stated. And I think that's nicely demonstrated on the next page, which quantifies, the performance of active core plus managers over the last 20 years, really asking the questions of, how much on average, does a core plus fixed income manager outperform or underperform the benchmark versus their fees? So that's what this chart looks to, and what we can see in that kind of text under the dark green block is that the average outperformance on a rolling 3-year basis is close to 1%. That's gross of fees. And then the average manager beat the index by at least 40 basis points. So that's pretty close to the active management fees that we pay in the portfolio, about 85% of the time. So demonstrated ability of active bond managers to add value over time, which is exactly why we don't use passive management in the portfolio.
So I have 2 questions on this slide. One question, why show the gross there?
Why show
gross return?
Because we don't know what so this is a generic slide for any investor.
Mm-hmm.
So for any investor, we don't know what fees they pay. But if you wanted to look at, like if your weighted average expense ratio is 40 basis points, that's the left to right. You'll see that if you pay 40 basis points, the average manager still outperforms that hurdle 84% of the time.
Okay.
So that's why we show it this way, because there's some investors who are big, some investors who are smaller, and they could have a different weighted average expense ratio.
And then my second question is about basically, what database is this exactly here? Is this a Callan one?
Yeah,
Okay.
we have a collection, we have a database, and we create peer groups with our database. And there might be 40-some products in here, maybe Dario can fact check me on that, but it's.
I'm basically just wondering, is there survivorship bias in this particular
Yes.
graph and data set?
Yes, but. So the thing about survivorship bias is, what that means is, let's say you had a firm who went out of business, and they went out of business because they had bad performance. And they went out of business 3 years ago. So if you look at their 10-year return ended today, it ain't in the database, right? However, this is our database. We control the way it's constructed. That's the advantage of us having our own database. If you look at a rolling 3-year return 4 years ago, it is in the database, right? So the bottom chart here, yes, a cumulative return for 20 years, they're not in it. But if you look at every rolling 3-year time period in this chart here, they are in it.
So some funds roll off, new funds roll on, and that's basically being captured in the 3-year window.
The peer group is frozen every quarter. Yeah, so that's how we control for survivorship bias.
And currently there are 75 constituents in this peer group specifically.
Thank you, Daria.
Underselling it there.
And this is labeled the Callan Core Plus style, so it would not include just solely Core. It's only Core Plus, or is it a combination of Core and Core Plus?
This is Core Plus.
Okay.
Yeah, and Dario, that 75 is for Core Plus?
That is correct, yes.
Okay. Yeah.
So it's probably the same for the core manager also. You could get a sense for that maybe if you go back and look at the Callan quarterly reports and you look at the individual Dodge and Cox numbers, because Callan's reporting them as core and Dodge and Cox and Core Plus and PIMCO. So you can go look at that if you were curious about it.
So, the big takeaway here is fixed income, it's been a great place to spend active risk, but it doesn't always work. And if you look at the chart here, look at 2008. So that's the global financial crisis, the GFC. That's when people thought, Fannie and Freddie are going under, and Bear Stearns went under, and Lehman went under, and it was a terrible time for a active fixed income manager who was exposed to or overweight any of that stuff, right? Charles, you might remember those days. And so you'll see for a rolling 3-year time period, annualized underperformance of 3%. So that means in 1 year they were underperformed by 10%. And that year the index was up 10.5, and you had people posting negative returns. So that was an extraordinary time period. So we just want to say that it doesn't always work, and there's certainly time periods where it does not work. But over the long time, on average, it's a good place to spend active risk.
I went on CalSTRS board.
Oh, it's quite an introduction.
Lose $30 billion in a month.
So the top graph really shows that the higher the fee for these fixed incomes, the more difficult it is to beat.
Indeed.
Mm-hmm.
Indeed.
And yet,
Mm-hmm.
with those two, Dodge and Cox and PIMCO, it's around 45%.
Basis points, yeah.
Yeah.
So their weighted average fee is between 40 and 45. Yeah. And so that's why we're looking at the PIMCO. Fees are really important in fixed income. The absolute returns are less, expected absolute returns are less than equity. The dispersion of returns are more narrow than equity. So fees are pretty important.
So that's why we're looking at the CIT.
Exactly, exactly. Well, maybe I'll share a couple things that others have been looking at and have considered for investing. At the end of the day, you have 21% of the portfolio allocated to bonds. If you had 40% to bonds, we would be more enthusiastic about you doing something else to amplify those returns. But being that you only have 21%, we think let's focus it on it being more of a duration exposure to hedge equity risk and flight to quality environments. That's more of what we want the fixed income to do when you have so little allocated to it.
Is that truly so little? Or how do we stack up in terms of our asset allocation on fixed income compared to other other organizations size?
Yeah, so I would say overall your fixed income implementation and allocation is kind of within range of your peers. Just a couple or a few data points, looking at Imperial County, Merced, Tulare, all are kind of in the 17 to 22% to core fixed income.
Are they including the assets that we're not in, the private capital into that?
So that 17 to 22% is really just the core plus, okay. and that allocation is really more similar to what you have than different. Some of your peers have smaller allocations to other things,
right.
Emerging market debt, tips.
So when you say only, that's a really relative only. We're appropriately allocated.
Yeah, we think your asset allocation is appropriate, and at one point you had about 5% more in fixed income, and that was reduced during the last asset liability study. I think it was 5% more. I'm pretty sure it was
2017.
2017, yeah, 2 AL studies ago.
Are you sure?
Yeah.
Last time they kept it steady.
Well,
time flies.
We changed it,
up, and then we went back to not changing.
We changed it, and then we didn't change it.
Yeah.
Right? And I think that was about a 5% difference.
No.
No?
You're definitely thinking about 2017 when we had that significant larger allocation and went into international. And even though Greg may not be remembering the exact time frame there, he is correctly recalling that we've sort of peeled off more and more from both equities and fixed income, and we've gotten into infrastructure in 2019, and which we funded in 21. So we've sort of peeled that back a little bit. One other thing that I'd mention, Callan is exactly correct on those asset allocation numbers from the other systems. And what I would also add to that is that all of those systems, Tulare, Stanislaus, San Joaquin, Sonoma, Merced, ICERs, they basically are quite a bit larger than us, right, on the one hand. And they really, in their core allocations, have maybe one more manager than we do, right? So something that I think about when we're talking about this is basically manager risk. Do we have enough managers? Do we need another manager? If you were to look at those systems, they maybe have one more manager basically than we do in the core allocation than where we are today, which is, not a whole lot more. And
in some cases, it's passive
targets
too.
Yeah, and that's a good point. Total bond index, I think, is one that I'm remembering. So, yeah.
Knowing that Stan Conwell focused on his professional development with alternate investments, and he moved to Stanislaus, is Stanislaus really having a alternate investment as part of their portfolio?
So let me answer that. They've got a 4% credit, core credit allocation like our two managers. They've got a 6% specific treasury allocation. They've got a 7% intermediate core allocation and an 8% private credit allocation. So they've got a little bit more. I don't remember off the top of my head when they got into private credit, but they've got a little bit more complex core structure, that they've got specific treasury allocation, they've got the intermediate, they have the private credit, they have a separate credit allocation. So it's a little more complicated, but I couldn't tell you when all that stuff.
No, that was the general gist of my question. You've answered. Thank you.
Well, maybe a couple asset classes we wanted to address, and I'm happy to speed up or slow down at any point. But one, global fixed income. Some people, so 15 years ago, the new shiny thing was investing in active global fixed income, because those managers tend to outperform the benchmark, and they go on and say, hey, you need this for the alpha, the global fixed income. Our reservation was always, well, what about the beta? You're going to outperform a slow index, an index we don't like because the yields are low, you got currency risk and long duration. So that didn't feel like a good opportunity for us, and that remains true in my assessment, in my point of view at least, today. So,
so real quick, when would that change for a system like MSERA?
Wanting global fixed income?
Yeah, when does that become a consideration for somebody like us?
Yeah, and like you said before, your PIMCO portfolio can opportunistically invest in non-U.S. bonds to the extent they think it's a good value add relative to the United States. I think that's the way to do it. If you built in a strategic asset allocation to global fixed, I would, our U.S. yields and expected return less than the expected return internationally, less than the yields internationally. And that's when you might say, hey, this could be a diversifier, not just a return give up. I think at that point it would be more interesting. I mean, we've looked at Japan, their low yields for so long. That's a meaningful component of that index. And there's also an advantage of having a flight to quality asset being US dollar denominated as well.
You mentioned international. What countries, because I think with the capital restrictions, investors are somewhat still staying away from China, but for fixed income international, what are red flags or non-desirable international country?
Well, there are a number of risks for a bond manager. One is interest rate risk, always the biggest one. Who's going to be increasing interest rates and for what reason? Do they have high inflation, for example? Do they have external investors taking money out, which drives up their yields? So duration risk is always the most important risk. There's currency risk. If it's not US dollar denominated, what's going to happen with the euro versus the dollar, for example? And then with a lot of sovereign international debt, so something offered by Mexico, there is both the ability to repay and the willingness to repay. These are sovereign entities. Yeah, and they want to be able to access the markets in the future, so they want to, but at the end of the day, they decide to repay their debt, right? And so that's something to think about. It's really mostly and only applicable to emerging markets. Argentina has historically defaulted multiple times, so that's something to think about if you ever were looking at emerging market debt. Yeah, so a few things to think about there.
So we are about an hour, and I think this is very important for trustees to get through, and I know we're asking a lot of questions here, but can we try to speed through slide 13, 14, 15, and 16 to kind of get through those?
Yeah. And
because I like those slides a lot. I think they're important.
Yeah.
if you don't mind, I do want, because a key important point for me is actually on slide 12. And so what we're showing here are correlations. So rolling 3-year correlations. And a correlation is how does one asset move in regards to another asset's movement, right? And this is the correlation of different bond markets to your US large cap stocks. So a high correlation means they move in lockstep, a low correlation means they're diversifying. So what are the high ones? And look how high they are. 0.8, 0.9 correlation of emerging market debt, high yield bank loans to the US stock market. So those asset categories in fixed income produce a higher return, but they do not diversify the big risk factor in your portfolio, which is the public equity market. So that's why we think having a simple, more investment grade focused portfolio makes sense for you. And if you only have 21%, that's why we don't recommend you go out and invest in a bunch of more credit risk seeking fixed income strategies. Okay? The things that do have a negative correlation are not always negative. So look at treasuries and the ag. The ag, you'll see it jumped up in 2022. The correlation, that's because rising interest rates hurt both stocks and bonds. But over a lot of when we do our capital market expectations, we assume kind of a roughly zero correlation. They're lowly to no correlation, not necessarily negative correlation, but lowly to zero.
Can you tell us kind of why the correlations? What are some of the reasons why the correlations on the right side of this graph are jumping up so much?
With the green
I
bar?
mean, we know that the Fed raised rates at that time. We know that happened, but I mean, is there a big difference in the operating environment from 2011 to 2021? I mean, why is it thought that those would be going up like that?
So are you talking about the green ones?
Yeah. I mean, everything is converging on the 23, 24, right?
Yeah.
I mean, everything's coming together there.
So this is looking at rolling 3-year backwards. So anything that captures 2022, the calendar year 2022, when the Fed increased interest rates by 5%, 4%, anything that has that calendar year in it is going to show a high correlation. So it spiked for 2022, and you'll see it drops. So 2025, we're rolling 2022 off, right? It's rolling off and it's coming down. But most of the other time periods, it's close to zero. So the correlation increased meaningfully because both stocks and bonds, all risk assets were being driven by the Fed increasing interest rates.
Which was a function of their perception of inflation?
Well, at that time, remember, inflation was already running at 9.
In 2022, right, 21, 22, by 23, which is including part of the pandemic, we've jumped up to 0.5 already, right? Am I reading that
right? Yeah, as soon as you start including 2022, rolling 3-year backwards, it starts jumping up. Yeah.
So interest rates again.
Yeah.
Emerging market debt would not include Russia, right?
No longer, but it did previously. Yeah. So pre-Ukraine, there was emerging market debt, and there was emerging market equity in the index. No longer. Okay, so maybe on slide 13, this is how we come up with return expectations for fixed income. And on the right-hand side here, you see the far right 2026 expected return, projected standard deviation, that area in the blue box there. you'll see that we expect the broad market, the aggregate, to outperform short duration bonds and do so with about 2 more units of volatility standard deviation for that increased expected return. Long bonds, yeah, we expect them to give you about 55 basis points more in return, but it more than doubles the volatility. So for an absolute return investor like you, we don't think that's a really good risk-return trade-off. But we do think you pick up a little bit of money and just a little bit of volatility by going from short duration to being the aggregate. So that's why we wouldn't say put your money in defensive fixed income, because there is a yield give up and a return expectation give up based on that. The number one risk on 14 of a bond portfolio is increasing interest rates. And so this quantifies the level of drawdowns we've had in the fixed income portfolio. So over individual time periods where interest rates have increased, most of the time the losses are, 1%. But then you get to the 2022 time period, you saw a 10% decline in the bond market because of rising interest rates. And then we have other time periods where, the losses are very short in duration, but it can be a negative 5% return. Okay. So there's been a lot of talk about private credit, and that starts on slide 18. And a number of your peers have built out portfolios, private credit portfolios. Over the long run, it might work out for those investors who have built out these mature, long-standing portfolios. But right now, you've probably been seeing a lot of headlines about private credit. These things called BDCs and all of this stuff that's going on right now. So it's a big trend right now, and a lot of people are talking about. A lot of people have built out these portfolios. Again, with a comparatively low allocation to fixed income, the fact that you don't have private equity, it kind of says, well, why do I want private credit? And by the way, that's just lending in part to companies. There's a linkage between private equity and private credit.
Could you comment on Oregon's, I'm not sure if it was private credit or private equity difficulties?
I don't, I'm sorry, I don't know what that, State of Oregon?
State of Oregon had some difficulties in their investment portfolio, and without having to go back to the article,
okay,
I wanted to just,
if
there were some insights that Kellen.
I would have to do a little research on them. I don't know.
If you could maybe just do a little research on that and forward it to Robert.
Okay, sure, yeah, that'd be great. Noted. Now, with private credit, maybe we'll flip ahead to slide 20. We do think there is a return premium for private credit over the long run, but it comes with additional volatility. So you'll see here we've got the private credit expected return. Let's stick with the geometric number of about 7.4. So there is a return pickup. But look at the standard deviation of 16 next to it. And you'll see that, well, that's multiples time what we're forecasting for the investment grade broad market. Most of the return is generated by a higher yield. It is floating rate too, so there's some advantages, largely floating rate private credit. There are other asset classes that could be more return generating and differentiating than private credit for you over the long We just kind of, in the interest of time, we just kind of wanted to make sure and acknowledge it. There's been a lot of talk about private credit. A lot of people have built out private credit portfolios. It's kind of the buzz. And we have a number of clients who are invested in private credit. But right now, and also in particular, absent your lack of private equity, I don't know if it's a great fit for Sarah.
And when would it be?
When would you want to invest in private equity?
Well, when would private credit? It's the same question.
I mean, it's part. I think it's part and parcel. Like why on the debt side is different from the equity side, and there are differences, right? There are differences, but there are a number of hurdles in the private credit market that exist in the private equity market too. Whether liquidity, fees, valuation, capital calls. There are complications on that private credit side, just as there are on the private equity
side. And I guess help me understand the yield versus the 10-year geometric return being the same number for private credit.
Well, they are closely linked, right? The yield of the portfolio should be very similar to the expected return of the portfolio. Their arithmetic number is a little higher, and that's because we model a little bit of higher interest rates over the forecast time period. Being a floating rate security, it'll generate more over the longer time period. You'll also see in the Bloomberg aggregate that the numbers are very similar to each other too. The starting yield and your expected return are very similar to each other.
I remember Dodge and Cox folks kind of mentioning that when a former trustee asked them, what do you think the next year return's going to be? And he just basically said
Yeah.
But to me, that's counterintuitive. Maybe I'm not just understanding really what private credit is. But
Well, you're not looking at any price appreciation, so all of your return comes from yield.
that's what I'm understanding there. And I'm like, I don't know about that. But another discussion.
Yeah.
We digress.
Yeah. So, net, we'd be happy to expand upon any of these individual topics more in the future. But kind of net, we think what you have right now has worked pretty well for you. And we think it serves the defined role that it is in the total portfolio. So we don't have any recommended changes. Sometimes it's good to go through and take a look at what you're doing and you say, oh, what we're doing is okay, and just verify that. That is an active decision to say what we're doing is good. That's an active decision, and that's where we're at right now.
Okay, does that conclude your presentation?
Indeed.
Is there any last questions or discussion on the item? Thank you very much.
Okay.
Thank you for your presentation.
All right.
So final comment, I guess I have on that. Can I?
Yeah.
Going back to the CIT, is the board's okay with continuing the review on that? Potentially, we would bring back a brief memo explaining the differences, because I do think there's some notable differences in there.
I don't think that's even something we would, it sounds like research,
Yeah.
right? So yeah, you can research anything you want. Yeah.
And we're happy to help you with that, Robert. Yeah. Okay.
All right.
Thank you. Thank you.
We're going to jump right into item C, preliminary monthly investment performance report. Robert Ravalis, retirement financial investment officer.
Trustees, you have the monthly performance report in front of you. Obviously, March was was a rough month with the start of the Iran war. So that was, concerning, but things have turned around, so that's a good thing. The one item I guess I want to point out, which can be seen on the second page, is the pending trade going towards Kane Anderson of 11.4 million. Not only did we rebalance at the end of the quarter, but we raised some funds to send them some money. So that gets our balance with them to 20 million. We're working towards 30-something million, low 30s.
31, wasn't it?
Somewhere in there, 30, 33 million, somewhere in there, yeah. So we're gonna commit additional funds probably over the next 2 quarters to try to get to that $30 million while maintaining our target asset allocations within, I hope, 50 basis points or so. So you should see that in the next monthly report. We're going to be taking care of that very soon.
Okay, is there any questions on this, comments? Obviously, it was a rough month. There's a lot of red on this.
Don't like the red.
And I know Robert's going to fix it, and there's going to be a lot more black next month. Full confidence. I guess that concludes it. Okay, so we'll move straight on to, unless there is public comment. I don't know if we need to take that. Don't
There
believe
is
we
none.
need to. Okay, item 6, board policy review. Doris Rensler, Executive Director.
Thank you, Chair Land. This item is coming back after our discussions in February and I believe also in March about the discrepancy between language in a couple of our policies as far as delegated authority. And this brings back the budget adoption policy, the Board of Retirement charter, and the authorized signature resolution with some minor changes to the language to align the delegated authorities with other documents that the board has. Specifically, the budget adoption policy has the amendment that we talked about last month regarding investment management fees and investment expenses in general, and whether or not those items need a budget amendment brought forth. We also have a small change in language in the Board of Retirement charter, changing the use of the term all else to day-to-day administration, and a change in the signer resolution to indicate that board direction needs to have been received before staff would contract with a service provider that is reserved for the board, that is consistent with the information in the board charter. So if you have any question regarding any of the edits, the red lines are all provided in there for you. I'm happy to take any questions.
It just seems like these are all things we discussed last time. It looks like you did what we had to do. And so do you need a motion for this?
Yes.
Can we do a motion for all 3 at once?
Correct, you can.
I move approval of the 3 changes, 6A, 6B, 6C.
Okay, we have a motion. We have a second. Do we have any public comment or any comment? Discussion?
There is none.
Okay, let's go with a roll call vote, please.
Right. Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Ms. Cubison?
Aye.
And Mr. Land?
Aye.
Thank you.
All righty, that brings us to item number 7, board electronic signature policy. Doris Rensler, Executive Director.
Thank you, Chair Land. The county employees retirement law indicates that MSERA can accept electronic signatures if the board is comfortable that the signatures are prove intent to sign, consent of the parties to assign. It keeps an associated record, and record of it, of the signature is retained. So board policy would be that we are asking the board to accept the use of electronic signatures either through DocuSign or when we receive a document through Member Direct, either through a process in Member Direct or through the secure communication channel within Member Direct due to the login and registration requirements and the two-factor authentications. So there is a draft policy attached here that we're looking for direction, or rather a motion from the board to adopt. If you have any questions, I'm happy to take questions.
Specifically DocuSign, rather than Adobe Sign, for example.
We could look at expanding it. At this point, we did just include DocuSign. DocuSign is one of the largest.
Been around forever.
Yeah, premier. The county has a contract, and we can certainly utilize the county's contract as to permit us to send envelopes. So it's a process that we'd already explored because the county is using DocuSign.
Makes
and
sense.
They're known for being, relatively secure. They have a lot of safeguards and history under their belt.
LPL just switched from DocuSign to Adobe Sign a year ago. We kind of all missed DocuSign.
Good to know.
And this,
There's other.
Jerry, did you have?
Yeah.
No, it seems silly to me that it costs $8 per envelope.
And that's for their obviously process and uses their cloud services, etc. Now we do have options that may not require any cost if we're doing it through Member Direct as far as processes or the secure communication channel there. The per envelope cost is subject to change, and depending on volume, that might go down. Also, I think they're moving to a subscription base instead of a per envelope base, and perhaps Alex knows more about that than I do.
I do.
You don't?
I do.
Oh, you do?
Yeah.
But at this point, because it's been approved by the county, we also thought that it would be appropriate for us to use that communication tool.
So the language, though, is it specific to use DocuSign or just electronic signature applications?
The policy says the board has to approve the method of the electronic signature, and our policy is currently drafted, lists DocuSign or through our member portal, and those are the two items. Now we can go back after additional research and edit that in the future and add Adobe Sign or something else if we felt so compelled.
Just open-ended, kind of nice.
But right now it's a list in the policy.
Yeah. Okay, so a couple of things. I also noticed the inclusion of specific vendors, and I understand why. We will be bringing this. I like the policy for the most part the way it is. It's fine. It can get us going, get us started, which is something I think I may have nagged you about. But it will be coming back when we move to DocuSign IAM, if and when we do, which I anticipate we will, probably next year. When I say we, in this case, I'm talking about the County of Mendocino, not Board of Retirement. And I think that we'll need to be ready to modify this pretty rapidly when that comes around.
So why does the policy, if the policy specifies DocuSign, require amendment if you go to DocuSign IAM?
Maybe it doesn't. Maybe I was conflating. We'll be fine with the policy on DocuSign in that case, but the price that was listed before will change.
The price is in the board cover memo, but the price is not in the policy.
The price is not there. That's fine. Okay. And the other thing I wanted to add is that I also noticed the lack of Adobe Sign in there. We do some of that. I don't know exactly what we're licensed for. That's one of the problems that I'm sure you have. Is with DocuSign, if you, if you send it an envelope to somebody, they can access it, they can sign, it doesn't cost them anything. They don't have to own anything on their computer or have, I haven't found that to be the case with Adobe Sign. People can have their own version of Adobe and it can get them away. I've been very frustrated figuring out how to use it myself. So I was also going to mention Adobe Sign. We might be, adding things to this if there's other services that we would have.
Yes, we can certainly bring the
Potentially, so-
policy back if there were other electronic signing services we wanted to include.
And there was one other comment that I had here. I suggest we alter the text that says a wet signature.
Okay.
I think a better description of that is a physical signature. I mean, it's even in hard quotes here. So I think it's probably a little informal to call it that. I don't know if that's an official term.
Sure. We can
Physical,
switch that to
physical signature, I believe, would be a little more accurate and maybe a little more.
And with the $8 per envelope, do we have an idea of how many envelopes we use annually? Or?
I don't anticipate that it would be particularly high. The majority of folks retiring, say, are coming into the office. Now, we do have some where we've been handling it by mail, and Judy might have an idea of how many people we do by mail, because I don't live in the area anymore when they actually go to draw benefits. But we could use this for that purpose and have them sign all of the documents in the retirement application. It's one envelope, so it would be $8 to get that back, and it would avoid maybe the necessity of sending it back and forth and that collection of stuff. But
So the county has purchased 2,500
per year, or is that
for
like
this year.
for
For this year, we have the most that we've used is 1,500 or 1,600. We have a slightly better price than 8. 8 was our previous price. That's the worst case price. I think it's a little bit better than that. When we moved to IAM, it's almost impossible to say. I don't know how it made it through the marketing people. IAM. It will be a fixed cost, as many envelopes as we want, but also much more expensive.
because it's based on like a prescription per
It is.
user?
It's and then we'll have to look at allocation of users, which is why I know this will be in one way or another coming back.
So that actually is a question. We could limit those individuals who are authorized to send out the Adobe Sign envelopes to 1, 2, 3.
Yes.
It doesn't have to be every single person in our office.
It won't be able to be every single person. But the current version, we could sign everyone up right now to use DocuSign. And in fact, I think I had mentioned that some of the signatures that you collect, I don't think we would have been needed to go through the board in order to begin to use that process.
Correct, and this policy actually focuses on member documents. It does say in the first paragraph that it doesn't prevent us from using electronic signatures even beyond those in this policy for regular business of MSARA, just that these two specific applications are those that are limited to accepting documents from members.
Because if HR sent you something,
I would Adobe sign? No, I could use whatever.
yeah, you could sign it, and that would not require this policy to have been in effect.
Right.
There's probably other things as well.
So we can, matter of fact, I had executed a contract with the new actuarial firm, I think it was, and they sent it electronically, and I signed it on some website. It wasn't necessarily DocuSign, but was similar, and we did execute the contract electronically with them.
What do you see with the custodial operations such as at State Street? Do you see?
I wouldn't be dealing with that necessarily, and I don't think anything necessarily would change there. A lot of that is done online. They have a portal that we use, but I would direct that question to Robert.
And I would ask for elaboration on
Well,
exactly
I'm just trying
what-
to understand it. Do you still use like DocuSign even with custodial operations?
No.
Or is it physical?
No, it's a combination of different physical things, emails, faxes, and their portal. So kind of those three ways to communicate.
But we don't do any electronic signature with State Street. But we do utilize their portal, which one could argue that if you set up a transaction in your portal, that's your authorization of it. And I do log on and approve those, so.
So yeah, those types of approvals are adjacent to signatures, but they're not necessarily signatures. People have become accustomed to accepting them. That's how we approve payroll. There's no physical signatures on a lot of that sort of thing. So, or even digital signatures. It's just an approval of workflow process. I don't think this would impact any of the workflow processes that you already have established for trades and for what have you.
No.
But if potentially, if there was a new contract you were entering into, either they could initiate a DocuSign, which is more likely than us doing it, and then we wouldn't have to pay 8 or any money at all.
I'm going to send an envelope next week, I swear.
Okay, okay. Send an envelope. Yeah, and I mean, we do, I've been scolded a few times for using an envelope internally because somebody's at home and I need to get a signature immediately, and they're saying, hey, you're using $8. I say, yeah, it's so. You know, but we do, there does need to be a little bit of prudence if you don't need to.
Right.
If somebody's sitting across the table, you can get a physical signature.
Do you need a motion?
We would need a motion if the board wishes to adopt this policy.
Okay. I move the recommended action.
I would like to say the recommended action with the alteration.
Yes.
If we can change the
As
motion.
amended by Trustee Land's correction to physical signature.
Yeah. Okay.
Second? Roll call, please.
Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Ms. Covison?
Aye.
And Mr. Land?
Aye.
Thank you.
Okay, that brings us to item number 8, quarterly board work plan, staff work plan, and strategic calendar. Doris Frenchler, Executive Director.
Thank you, Chair Land. The 2026 board and staff work plans are in your materials. The plans are still being updated a little bit for the updates to the strategic plan that the board authorized 5 or 6 months back. I wanted to let you know also that we've modified the strategic plan document and have reposted it to the website. So it is the updated version, which includes the new objectives and measures that the board approved a few months back. So if you have any questions on anything on the strategic plans, I'm happy to review that with you now. Otherwise, we can move on to the next topic.
Are there any questions? Seeing none, we will move on to item number 9, the administrative report. And that would be Doris Frenchler, Executive Director.
Thank you, Chair Land. We held the special election for the retired member seat 8. The election was held on Friday, April 10th, and we received 303 ballots for the retired member election. There were 14 invalid ballots, and the final tally was 170 votes for Vince Lekowick and 119 votes for Leonard Swope. So Vince Lekowick will be joining our board at the May meeting, and I'd like to congratulate him. He stepped out of the room, though. Oh, no, there he is. He's hiding. I couldn't see you. So congratulations, Vince.
I'm not sure that's the right word to use, but thank you.
I had spoken with the board about the Chief Officers Summit, which is an NC PERS event that's coming up in June, and it conflicted with the board meeting in June. Due to some other items, I'm not planning to attend that, so I'm not going to ask the board to change the date of the June meeting. I also wanted to let the board know that I dropped in uninvited to the Rotary meeting and tried to drum up some interest in serving on the retirement board as a Board of Supervisors appointed member. They were very kind to me, and I appreciated the collegiality and allowing me to join them for lunch, and then also take time and present to them about Sarah and serving on our board. So my thanks to the Ukiah Rotary.
Which Rotary, South or?
The one that meets at Star's Restaurant on Tuesday, because I just walked over there and crashed their lunch.
Charlie, was that yours?
No, that's the other one.
The other one.
I'm sorry, I didn't know there was more than one, honestly.
The larger by far and more active.
Well, if you want to send me where they are, I'd be happy to.
Stars Restaurant, 7 a.m. Thursday.
7 a.m. Thursday. All right, I guess I got a breakfast meeting now. No,
So on that, to qualify for that, you cannot be a retiree, correct?
That's correct. It needs to be a citizen that essentially has no relationship with the county, so they can't be a contractor or employee or a retiree kind of.
Which narrows the
two people that I thought would be a good replacement for me were both South Ukiah Rotarians, one of which is down, and one left. So we would have had a couple of, at least one.
I do appreciate the effort there, though, and I've actually considered doing something similar with the sheriff's office.
I have spoken to both the sheriff's admin, the probation admin, their labor groups, and just started sending random emails, but none of that has been successful in trying to drum up a safety candidate. But I'll keep poking, see what we can uncover. One of the last items on the administrative report is actually an action item. Although we were told we would have the Sackers business meeting packet, we never did receive that, but we do have the slate of candidates, and we are looking for direction from the board on the slate of candidates for the Sackers Board of Directors, because the trustee or staff in attendance at the spring conference in May will be asked to vote on the slate of candidates at the meeting.
I guess that, is anybody actually going to that one?
I believe trustee Haschuk is, and I am also attending.
Okay.
So it's really approving the slate. That's the question.
Yes, you can look through the names of individuals who nominated themselves for consideration. Then this is the slate put together by Sackers, but you can actually vote for someone not on that slate. But we are looking for board direction for that person who attends the Sackers business meeting at the May conference on voting for the board of directors.
My opinion would be to approve the slate as for the volunteers. People who volunteer, the people who've been nominated.
I'll second that if that's a motion.
I don't think it is a motion. I don't think it's required that we do a motion. Do we need a motion for this?
Jeff, do we just need direction?
I don't think so. I think direction is fine to the delegate.
Objects to that being our direction?
Nope.
Okay, so, and that sounds like trustee Haschuk will be the one to vote. Requires you to be there on the last day.
Okay.
It's a lot of fun.
Where is it?
Is that the end of our item 9?
That is the end
Palisades.
of the administrative report, item 9, yes.
Experience study and budget sending out.
I actually have a couple of other comments. We're in the process of doing an experience study. That experience study will be completed by Siegel as part of the work under their contract, with the transition to Chiron being for the June 30 valuation. I just wanted to let you know that Siegel will be here, whether virtually or in person, I don't know, at the June meeting to present the experience study. Also, it is budget time, and Robert's staff will be sending out the draft budget for the board to review. And if you have any suggested changes or questions or things that you would like to amend or include, reach back out to us. You have a 2-week window to review the budget, and then we'll bring forward the draft budget for approval at the May meeting. Anything else I forgot to mention? Thanks.
All right, item number 10, general board discussion. Are there any items people would like to discuss? Nothing?
Are we on number 11 getting time to chime in on?
We will on number 11, yeah.
Okay, that's fine. Then I have
Yeah, there's a note there. No discussion. Okay, that will bring us directly to item number, adjournment in honor of James Anderson, past retirement administrator and trustee, and notice of next Board of Retirement meeting. So I believe we should have a discussion item there and allow people to talk a bit about James Anderson. And he was the CAO of the county when I first was hired at the county. And I've known him ever since. I did not know how involved he was with McSarah until I became
He was MSARA's first administrator, if I recall correctly.
I do recall that.
Yeah, before Tim. And then he came back and served on the retirement board, so.
And he went to Sonoma to serve as the assistant CAO for Sonoma.
And he was very welcoming when I joined the board. He was on as I believe, the alternate retired member. And he was just really kind and nice. I do remember that.
I went to his memorial. Obviously a man well liked and respected in the community. I think it's a real loss to lose him so young. To lose him, period. But at 66. That's not fair. And he did called me and expressed an interest in coming back on this board after the various commitments that he had that made it difficult for him to serve. So he had obviously good feelings about him.
Well, he was a far-sighted individual when circumstances were such that he was debating to care for his mother or re-up. He looked at my background. I could tell it from LinkedIn. He looked at my background and then gave me a hint that he was maybe debating whether or not to re-up. And I had reassured him that when my mother passed on through Alzheimer's, my sister and I, when she passed on, we cleanly just went to, I mean, of course there was grief, but we went to the restaurant right across from the hospital, and there was no regrets for the time that we had invested with Mother. And that he said he thanked me for that input, and he felt he was reassured by that. So he was looking for candidates, since he was not going to re-up, for people he thought would have the background to serve on the board, and I was grateful that he did that, and I am here on the board partially because of that.
Okay. This will bring us, I guess we're at 11, and I will make the announcement for the next Board of Retirement meeting. The next Board of Retirement meeting will be held in the Board of Retirement Conference Room, 625B Kings Court, Ukiah, California, on Wednesday, May 20th, 2026, at 8:30 a.m. Thank you. We are adjourned.
Look forward to seeing you in person next